Hi everyone, it's AJ with North Capital Mortgage, and today we are covering DSCR loans. Once again, we've had a lot of inquiry on these types of loans, and there's also a lot of confusion on these types of loans. People have been asking a lot of questions on how you qualify, what the DSCR ratio is, what it means, and how you can acquire an investment property loan without providing any personal income documentation. So all of these questions we want to address, and very briefly, we're going to give you a simplified understanding of how these loans work. But before we do so, I'm going to ask that if this video resonates with you at all, please send a like or follow the channel. It would definitely help. So 5 main points of a DSCR investment property loan. The first one is, therefore, investment properties only. These are business purpose loans. You cannot qualify with an owner-occupied residence or a second home. They are solely for investment properties. So very simple. Item number one. Moving on to number two, there are no personal income documentation or documents required. We do not look at your personal income. We are only looking at the potential income of the property itself. So this is a cash flow based loan. We're going to look at the cash flow. We're going to look at your personal credit and your credit profile, and that's how the underwriter is going to qualify you for this loan. Number three, DSCR ratio. This is the ratio that measures the cash flow. So let's give an example here. If you have a monthly obligation on the property, that's principal, interest, taxes, and insurance in any homeowners association of, let's say, $5,000. If your gross rent is $6,000, you have a ratio of 1.2. That means you are covering not only the principal, interest, taxes, and insurance, but you also have a 20% buffer. If your rental income on the property is going to be estimated by the appraiser at just $4,500, and your principal, interest, taxes, and insurance for the monthly obligation is $5,000, now you've got a ratio of 0.9. So when you look at the DSCR ratio, the best scenario is to have a 1.0 ratio or higher. That means your rents are covering your monthly expense. You're going to be able to put down a little bit less money, as little as 15% down, and you're going to have a better interest rate. If your ratio is below 1.0, you're still going to be able to qualify, but you may be able to put down, or you may have to put down slightly higher down payment, perhaps 20%. And if your income on the property is substantially lower, let's say $3,000, and you're at a 0.6 ratio, and you have a fairly large gap between your monthly income from rents and your monthly obligations, you can still qualify, but you're going to likely have to put down 30 to 35% to qualify for the loan, and your interest rate is going to be a bit higher. Okay, so that's what the DSCR ratio, it's how it works, and what it stands for is debt service coverage ratio. Number four, because there's no documentation for personal income required on this loan, you're going to have a much faster and much more simplified process. Usually we can close these loans in a couple of weeks, and this is going to be ideal for those investors or individuals with a more complex financial profile. If you own other rental properties, if you own businesses, you know that it takes sometimes a whole lot to put all that documentation together and to present it. And this way, with this type of loan, we can do away with all of that, and we're just looking at the cash flow of the actual subject property, okay? Number five, you are going to have slightly higher interest rates with the DSCR loan. Because this is a streamlined loan and we are not even looking at your personal income documentation, the investors and lenders are going to offset that by charging a slightly higher interest rate. There are times where if you have a great credit profile and you're putting down 20 to 30%, I have seen interest rates that are very similar to conventional loans. But if you want to put down less money and your credit profile is a little bit shy, you can certainly expect a little bit higher of an interest rate and a possible prepayment penalty. A prepayment penalty is when there's a period of time after you acquire the loan that if you pay it off, it's generally 2 to 3 years. If you pay it off within that time frame, then you will be hit with that prepayment penalty. You can acquire a slightly higher interest rate to buy down or buy out that prepayment penalty. And those are all things that we can discuss when qualifying you for the loan. So as you can see, there's a lot of benefits to utilizing a DSCR investment property loan to acquire real estate. It's very streamlined, it's a fast process, and it will do away with a lot of the headaches that come from putting together a ton of personal income documentation and different types of paperwork. If you have any questions at all, please give me a call, AJ at North Capital Mortgage. I'd be happy to assist in any way I can. Appreciate your time. Hope you have an excellent day.